Kelly, thanks very much. I am here in Washington with Fed Governor Chris Waller. Governor Waller, thank you for joining us.
Thank you. Hey, by the way, I hear birthday wishes are in order.
Thanks very much. That was not on the agenda here today. We've got a lot to talk about, but thank you very much. Can we dive right in and talk about the inflation dynamic as you see it? How was 2023 in terms of what has been called really the solid progress that was made in inflation differed so far from 2024? And how does that dynamic going to work this year?
Yeah, so I would say 2023, the second half of the year, we really did see a lot of unwinding of supply side problems. We also saw a large surge in immigration that wasn't really appreciated until much later. And that did a lot of things. One, it had a very positive effect on growth, employment, but at the same time, prices were coming down, which you typically would think would happen with a supply side. But the first quarter of this year, and what we're staring at now, kind of looks much more like demand side. So I've kind of argued in the past, a lot of supply side stuff, except for the immigration, is kind of unwound. And so what you're staring at now is much more demand. And that's where policy is going to have bite to kind of bring the economy back into a more moderate state and bring inflation back down to target.
So to the extent that you said this morning in your speech, you expect inflation progress to continue. Is it from the demand side and the weakening demand that you expect progress to happen?
Yeah, that is my view. Others may not, but that's my view, that demand, the supply stuff is pretty much running its course. It's kind of hard to appeal to pandemic supply side problems. When every firm I talk to, they're like, no, supply side is not really the problem. So in that case, it really is demand, and in that sense, it's just, strong consumer demand. They're basing that off of a very good jobs market. Their jobs are secure, their real wages are rising, and that gives you confidence to consume, particularly in the middle and upper groups. Now, some of the lower groups we're seeing a little more stress.
But you've seen some weakening overall in April, and that you think helps bring down the inflation numbers?
Well, the inflation numbers are kind of, they're kind of middling around the 0.3 monthly numbers. That's why I was joking this morning. The second digit seems to be a big deal, whether it's above 0.3 or below 0.3. But I think it will. Whatever we saw happen, we're going to see policy start to put more downward pressure on demand. We're seeing it through the labor market. We're starting to see it in surveys of manufacturing, non-manufacturing, things I mentioned this morning. So I think keeping the policy rate where it is, it's restrictive. That'll continue to sort of slowly grind down the economy, but not throw it off a cliff.
Tell us how you measure restrictiveness in the policy rate.
Well, I'm going to do the standard thing, which is I'm going to take the policy rate, and then I'm going to take off, expected inflation a year out. And when you do that, and those are roughly around 2% or a little above, so you're staring at a real policy rate of 2.5% to 3%. And I think that's by most kind of estimates a restrictive stance. Now, if you think, R star, the infamous R star, is much higher.
The neutral rate.
Then you're probably saying, well, it's not tight enough. But I think it is, and I think we're starting to see the moderation throughout the economy.
So baselines seem to have shifted quite a bit in the market. They shifted for Federal Reserve officials. Does your baseline still call for rate cuts this year?
Well, I would say that the data is not looking like we need to raise rates. So, like I said this morning, you never say never as a central banker, but I don't think we're going to need to raise rates. So that means either hold rates steady for longer, rate cuts get pushed out, and if the data were to continue softening throughout the next 3 to 5 months, you could even think about doing it at the end of this year.
So towards the end of the year, so not multiple cuts necessarily, maybe one or a few.
Depends on the data.
But it's got to be sort of consecutive, and it's got to show clear progress.
And we have to be confident. We thought we kind of had it through the last 6 months of last year, and then once again you kind of get surprised. So we just need to really make sure it's on its way down to target, and we think it'll stay there.
Do you think of rate cuts as a process, or is it possible to do one and hang out for a while, do another one? Or is it a process? And also, do you worry about the market sort of overdoing it if you start to cut rates?
Yeah, I think the idea you would say cut once and then sit for 6 months, I'm not really sure what you're trying to accomplish with that. So when you cut rates, it's because you think policy needs to be loosened or doesn't have to be as tight. And that typically isn't one cut.
Right.
So it's usually you want to think about a sequence of cuts. Well, whether you want to do them 3 or 4 consecutive meetings or go every other meeting, but the idea of just doing it once and then sitting there for 6 months just doesn't seem to make a lot of sense to me.
How do you measure the downside and the upside risk? Are they balanced right now, or do you have concerned that if you hang around at this restrictive rate too long, that you create too much momentum to the downside that maybe you can't control?
I mean, that was what we were worried about the first 3 months. The first month, January, you're thinking maybe it's some weird seasonal things, but we saw it again in February, we saw it again in March. We finally started getting some evidence that the economy was moderating on the real side and that we got a break on inflation if we get some more. That's why I don't think there's a lot of upside risk. And like I said, things could change and rate hikes could be on the table under some scenarios in the world. But right now, I don't see that as the case. More likely we stay where we're at for months. And then if we get enough data going the right way, then we can think about cutting rates